Welcome back, dear learners. So, in the first part of today's section, we have discussed leverage analysis, wherein we have understood that what do we understand by this term leverage. We have seen that how financial leverage, operating leverage and combined leverage is calculated, how these leverages are impacting the financial decisions of the company. We have also seen the practical examples of leverage analysis. We will continue in this section of this today's session with EBIT and EPS analysis. When we are talking about EBIT and EPS analysis, this is the analysis of the effect of different patterns of financing on the level of returns available to shareholders under different assumptions of EBIT, and this scenario is known as EBIT and EPS analysis. So, in simpler terms, how our EPS is reacting to EBIT, how our EPS will change when there will be change in EBIT. While discussing EBIT and EPS analysis, we will also see or understand the new terms called indifference level in finance. We will see, we have heard this term in economics for sure, but we will understand the meaning of indifference level in financial management terms as well. We will also see that what do we understand by the term called financial break-even point. Of course, we have seen this or listened or heard these terms in economics, but we will see that how these terms are impacting the financial decisions of the company. So, let us start this EBIT and EPS analysis. Before moving ahead, I would also like to mention that these two topics, leverage analysis and EBIT EPS analysis, are one of the simpler or easiest topics in financial management, and of course, these two topics are very scoring when it comes to this paper called financial management. So, let us discuss this EBIT and EPS analysis. Now, there may be two cases where we are doing this analysis called EBIT EPS analysis. Case 1, when we have constant EBIT and there is change in financing pattern. So, the pattern of financing is changing, but our EBIT is constant. So, this is case 1. We will see these cases with the help of practical examples. Then we have case 2, where our EBIT is changing. So, we are varying EBIT with different financial patterns. So, case 1, when our EBIT is constant, case 2, where our EBIT is changing with change in financial pattern. Okay. So, let us see this with the help of one practical example. So, this is scenario 1 or situation 1, where we have constant EBIT and our EBIT will be equal to 30% of capital that we have. So, the table on the screen will show you the pattern of financing or the total amount of capital and the sources from where the capital has been raised. So, the first source is equity share capital, which is available at the rate of rupees 100 per share, and we have 4 financing patterns or 4 different options. So, in option 1, we do not have any other source of funds here. So, all the fund is raised from one source, that is equity share, and the total funds are equal to 5 lakh rupees. Case 2, where 50% of funds are raised from equity shares and 50% of funds are raised from preference share capital. So, 2.5 lakh or 2,50,000 from equity share and 2,50,000 from preference shares, and the total funds in this case also will be 5 lakh. Then option 3, where we have raised 50% funds from equity share capital, that is 2,50,000 from equity share capital, 25% from preference share capital, that means 1,25,000 from preference share capital, and 10% from debentures. Okay. So, the 10% funds are raised from the debentures. Okay. Then we have this case 4, where we have raised 1.25 lakh from equity share capital and 1.25 from preference share capital and 50% amount from debt, that is 2.5 lakh from debentures. So, in all the cases the total fund will be equal to 5 lakh. Since our EBIT is 30% of capital, so in all the 4 cases our EBIT is 1.5 lakh, that is 1,50,000 in all the 4 situations, okay, because it is 30% of rupees 5 lakh. Moving ahead, we have taken this EBIT in this table. So, in all the 4 scenario, our EBIT is same, that is 1.5 lakh in all the 4 options, 4 cases. In first 2 cases, we do not have any amount that is raised from debt. So, the interest value will be 0. In second case, 25% amount, that is 1,25,000 was raised from debt. So, the interest is 10% of the amount which is raised in the form of debt, that is 12,500 rupees. So, we have to deduct this from EBIT, and in fourth case where 50% amount is raised from debt, that is 2,50,000 is raised from debt. So, the interest will be 10% of debt amount, that is 25,000. Again, in fourth case also we have to deduct interest amount from EBIT. After deducting interest amount from the given EBIT, we will get profit before tax, which will be 1,50,000 in case 1, 1,50,000 in case 2, because there is no interest in first 2 cases, 1,37,500 or 1.375 lakh in case 3, because 12,500 is deducted from 1,50,000. In case 4, it is 1.25 lakh, because 25,000 which is interest is deducted from 1.5 lakh of EBIT. From this profit before tax, we will deduct tax, which is given at the rate of 50%. So, it is 50% of 1.5 lakh, that is 75,000. In second case also it is 75,000. In third case it is 50% of 1,37,500. So, it will be 68,750 rupees. In third case it is 50% of 1.25 lakh. So, it will be 62,500 rupees. After deducting tax from profit before tax, we will get profit after tax, which is 75,000 in first case, 75,000 in second case, 68,750 rupees in third case, 62,500 rupees in fourth case. While moving ahead, we take this profit after tax in this table. From profit after tax, this is the profit which is left with us. We will deduct preference dividend, because we have to give dividend to our preference shareholders. So, in first case, in option 1, we do not have any preference dividend. So, there will be, the amount will be nil in case 1 for preference dividend. In case 2, since we have these preference shares of 12% for rupees 2.5 lakh, so there will be preference dividend of 30,000 in case 2. This amount will be 15,000 in case 3 and 15,000 in case 4, because 25% of total capital is raised from preference share capital in last 2 cases. After deducting preference dividend from profit after tax, we will get these values of profit which is available for our equity shareholders. It is 75,000 in case 1, 45,000 in case 2, 53,750 rupees in case 3, 47,500 rupees in case 4. So, this is the profit which is available for our equity shareholders. So, number of equity share which are there in our financial pattern are 5,000 in case 1, 2,500 in case 2, 2,500 in case 3 and 1,250 shares in case 4. Now, we will divide the profit for equity shareholders by number of equity shares which are there in our capital structure. We will get the value of EPS. So, this is rupees 15 in case 1, rupees 18 in case 2, rupees 21.5 in case 3 and rupees 38 in case 4. So, from this we can see that how well we are able to utilize the debt as we are about to increase, or we are increasing the debt in our capital structure, our earning per share is increasing. Let us see one more case when our when our EBIT is reduced from 30% to 18%. In case 1 we have taken EBIT as 30%. Now, let us consider this case 2 where our EBIT is reduced to 18% from 30%. So, in earlier case our EBIT was 1.5 lakh in all the 4 cases. Now, since EBIT is 18% now, so EBIT will be 18% of 5 lakh. So, 90,000 in all the 4 cases. Just like we have done earlier, we have to deduct interest from this. In first two cases, we do not have any debt capital, so we need not deduct any interest. In case 3 and case 4, we have to deduct interest, which is 12,500 in case 3 and 25,000 in case 4. We will get the value of profit before tax, which is 90,000 in case 1, 90,000 in case 2, 77,500 in case 3, 65,000 in case 4. Now, we will deduct tax, which is given at the rate of 50% out of this. So, in case 1 it is 45,000, in case 2 again it is 45,000. In case 3 it is 38,750 rupees and in case 4 it is 32,500 rupees. After deducting tax from profit before tax, we will get profit after tax, which is 45,000 in case 1, 45,000 in case 2, 38,750 rupees in case 3, 32,500 rupees in case 4. Taking these profit after tax values ahead in this table, now we have to deduct preference dividend because we have to give this amount to our preference shareholders. So, in first case, since we do not have any preference capital, so no amount will be deducted, but in case 2 we have to deduct 30,000, in case 3 15,000, in case 4 also 15,000. After deducting preference dividend from profit after tax, we will get the value of profit for equity shareholders, which is 45,000 in case 1, 15,000 in case 2, 23,750 rupees in case 3 and 17,500 rupees in case 4. Number of equity shares are same just in the previous case. So, these are 5,000 in case 1, 2,500 in case 2, 2,500 in case 3 and 1,250 shares in case 4. When we divide profit which is available for equity shareholders by number of equity shares, we will get the value of EPS. So, EPS is 9 in case 1, 6 in case 2, 9.5 in case 3 and 14 in case 4. See, you can see the difference. So, in previous case where our EBIT is 30%, the scenario, the EPS or the amount of EPS was different. But when we have keeping other things constant, our capital structure is same. The only difference is now we are able to earn 18% EBIT as compared to 30% EBIT in previous case, but it is impacting our EPS. See, the value of EPS has changed in this case. Let us see the second case or second scenario. So, in first case we have seen when our EBIT is constant, EBIT is not changing. So, let us see the second situation when our EBIT is also changing with our financing pattern. Okay. So, in this case we are taking 3 companies, A Limited, B Limited and C Limited. The capital structure for these 3 companies are given. So, for A Limited we have raised all the funds from equity share capital which are available at rupees 100 each. So, the amount is 2 lakh rupees and this is the total capital with A Limited. In second case, we have raised 50% from equity share and 50% from debt. So, 1 lakh from equity share, 1 lakh from debentures and the total capital is 2 lakh. In third case of C Limited, we have raised only 25% from equity share capital, that is 0.5 lakh or 50,000 rupees and 75%, that is 1.5 lakh rupees from debt. Again, the total capital that is available for C Limited is 2 lakh. So, the capital amount that all these 3 firms have is same. Now, ROI is expected to grow at 8% or we are expecting return on investment to be 8%, which may fluctuate by 3% on either side. When I say either side, so it may fall in bad situation to 5%, that means 8% will be reduced by 3%, and when the situation is good, okay, then it may increase by 3%, that means this return on investment may go up to 11%. 8% is something that we are earning in normal situation. So, it depends upon the economic condition whether it will fall or increase. So, we will see these 3 conditions when the economic situation is bad, normal and good. So, let us see that how this varying EBIT is going to impact under different situation. Now, from the table which is given on the screen, you can see there are three conditions: bad, normal and good. So, in first case, bad condition, the ROI is reduced by 3%. So, in normal condition when it was 8%, in bad condition it is 5%, and in good condition it is increased by 3%. So, in good condition it is 11%. Total capital is same in all the three cases, that is 2 lakh for under bad condition, under normal condition and under good condition. EBIT is changing in this case. So, 5% of 2 lakh in bad condition, the company is able to earn only 10,000 EBIT when they have total capital of 2 lakh. Under normal circumstances, the company is able to earn 16,000, which is 8% of 2 lakh. Under very good condition, the company is able to earn 22,000 as EBIT, which is 11% of 2 lakh. Now, let us see this for different type of companies when our financial pattern or the capital structure is also changing. So, for A Limited, the company with no financial leverage and no debt. Okay. So, EBIT is 10,000 under bad condition, under normal condition it is 16,000, under good condition it is 22,000. Since we do not have any financial leverage, so interest will be 0 and our profit before tax will remain same, that is 10,000, 16,000 and 22,000. Now, from this profit before tax, we have to deduct tax, which we are assuming as 50%. So, 5,000, 8,000 and 11,000 in bad, normal and good situation respectively, we have to deduct from profit before tax, and we will get the value of profit after tax, that is 5,000, 8,000 and 11,000. Number of shares are 2,000 in case 1, 2,000 in case 2 and 2,000 in case 3, because the total amount is raised from equity share capital only. We are considering the case of A Limited with no debt. So, for A Limited, in bad situation, the company is able to maintain EPS of 2.5. In normal situation, the company is able to maintain EPS of 4 rupees, and in very good situation, the company is able to give EPS as 5.5 rupees. So, this was the situation where we have no debt in our capital structure. Now, let us see the case of B Limited, where 50% is raised from debt. EBIT is same, 10,000, 16,000 and 22,000 under bad, normal and good situation respectively. But in this case, we have to deduct interest because 50% of fund is coming from debt. So, interest is 6,000 in all the three cases. We will get profit before tax after deducting interest from EBIT, which is 4,000 in bad situation, 10,000 in normal situation and 16,000 in good situation. From profit before tax, we have to deduct tax, which is 50%. So, 2,000, 5,000 and 8,000 under three circumstances. We will get the value of profit after tax, which is 2,000, 5,000 and 8,000 in the three situations. Since 50% of amount in this case is raised from debt and 50% from equity, so number of shares in all the three cases will be 1,000, 1,000 and 1,000. So, EPS for B Limited, which is 50% debt firm, is calculated, and in bad situation EPS is rupees 2, under normal circumstances EPS is rupees 5, but when the company is performing in good situation, the company is able to maintain EPS of rupees 8. Now, let us see the third case of C Limited, where 75% of funds are raised from debt. Okay, 25% is raised from equity and 75% is raised from debt. EBIT is again same in all the three cases, 10,000, 16,000 and 22,000 for bad, normal and good situation respectively. But since the 70% amount is raised from debt, the interest amount will be 9,000 in all the three situations. After deducting interest from EBIT, we will get profit before tax, which is 1,000 in case 1, 7,000 under normal circumstances and 13,000 when the circumstances for the company are very good. We will deduct tax at the rate of 50%. So, 500, 3,500 and 6,500 will be deducted from profit before tax to get the value of profit after tax. We will get the profit after tax as 500, 3,500 and 6,500 under bad, normal and good situation respectively. The number of shares are 500 in this case because only 25% of total fund is raised in the form of equity share. So, by dividing profit after tax by number of share, we will get value of EPS, which is rupees 1 in case 1, 7 in case 2 normal circumstances, and 13 in case 3 when the circumstances for the company is good. So, this is how the EPS is getting impacted when our EBIT is changing, and at the same time the capital structure is also changing. Okay. For concluding this, we can see this table that for A Limited, when the company does not have any debt, so under normal situation they are able to earn 100% EBIT, okay, but or the EPS is 4 under normal situation, but if the situation is bad, that means when the EBIT is reduced to 5%, so the value that is changing is, that means the EPS is also getting reduced by reduced to 62.5%. That means that there will be change of 37.5% on either side. The EPS is getting reduced. When the EBIT is getting reduced by 3%, the EPS is getting reduced by 37.5%. Now, when the EBIT is increasing by 3%, the EPS is also increased by 37.5% in case 1. In case 2 also, the change is again equal on both the sides. So, when the EBIT is reduced by 3%, the EPS is also reduced by 60%. But when the EBIT is increased by 3%, the EPS is increased, or the change in EPS is 60% positive. In third case also, when the debt is 75% and our EPS is rupees 7 under normal circumstances. So, when the EBIT is falling by 3%, there is fall of 85.7% in our EPS. But when the EBIT is increasing by 3%, we have positive 85.7% EPS in this case. So, this is how the change in EBIT and the change in our capital structure is impacting our EPS. Okay. Now, let us consider one more situation when the ROI is 6% and cost of debt is also 6%. Okay. So, since the ROI is 6%, our EBIT is 12,000 in all the 3 cases. We will deduct interest. In first case, we do not have any debt. So, no interest will be deducted. In second case, it is 6,000. In third case, it is 9,000. Profit before tax for A Limited is 12,000, for B Limited is 6,000, and for C Limited it is 3,000. We will deduct tax at the rate of 50% and we will get the value profit after tax, which is 6,000 for A Limited, 3,000 for B Limited and 1,500 for C Limited. By dividing this value by number of shares, which are 2,000 in A Limited, 1,000 in B Limited and 500 in C Limited, the EPS value is 3 in all the 3 cases. So, if ROI is 6%, that means cost of debt is 6%, financial leverage has no magnifying effect on EPS. So, in this situation, all the 3 firms will have same EPS when our ROI, return on investment, is equal to our cost of debt, right. Let us see this term called financial break-even level. So, this is the situation when the firm's EBIT level is sufficient to cover the fixed financial charges. Now, for firm B, financial break-even level is 6,000. So, they need to earn minimum 6,000 to reach to that level when we have no profit or no loss. And similarly, for firm C, it should be 9,000. They need to earn 9,000 to maintain break-even point. So, the financial break-even point is such a level of EBIT at which only company's fixed charge are covered and consequently the EPS is 0. Financial break-even point can be considered equal to our interest charge or the value of interest that we are paying. Okay. So, in case the firm has debt and preference share, financial break-even point can be equal to our interest charge plus preference dividend. There is one more term we have here is called indifference point or indifference level. The indifference level of EBIT is one at which our EPS under 2 or more capital structure are same. the level of EBIT at which the firm has two or more financial plans resulting in same level of EPS is known as the indifference level of EBIT. Use of financial break-even level and return from alternative capital structure is called indifference point analysis. Let us see this with the help of one example. We have two financial plans, two capital structure. In both the cases, we have number of equity shares as 10,000 in the existing scenario. But in financial plan 1, we have added or we are introducing new shares that are 1000 shares. So, the number of total shares will be equal to 11,000 in financial plan 1, but it will remain 10,000 in financial plan 2. There is no debt in financial plan 1, but we have raised 50 lakh rupees in financial plan 2. So, the EBIT in first case is 55 lakh, in second case also we are considering EBIT as 55 lakh. Now, since we have EBIT as 55 lakh in both the cases, we will deduct amount of interest which is 0 in case 1 and 5 lakh in case 2, 10% of debt amount. We will get profit before tax which is 55 lakh in case 1 and 50 lakh in case 2. We have to deduct tax out of this at the rate of 50%. So, it is 27 lakh 50,000 in case 1 and 25 lakh in case 2, and we get profit after tax which is 27 lakh 50,000 in case 1 and 25 lakh in case 2. Now, to calculate EPS, we need to divide profit after tax by number of shares in both the financial plans. So, in case 1, the number of shares were 11,000, in case 2, the number of shares were 10,000. So, in both the situation, the EPS value that we get is rupees 250. That means there is no change in EPS, whatever financial plan, whatever capital structure we have. So, this is the situation, we call it the point of indifference level, where we are kind of confused or we are not able to take decision that what plan we need to consider, because both the plans are giving the same results. Okay. So, this is all about EPS and EBIT analysis. So, here we come to the end of today's session, wherein we have covered our leverage analysis and EBIT-EPS analysis. Together we have explored these two fundamental topics today, that is leverage analysis and EBIT-EPS analysis. In the first part, we delved into leverage analysis. We understood how operating, financial and compliant leverage influences a firm's risk and return profile. We also saw how these tools can help assess the impact of fixed cost and financial choices on profitability and risk management. In the second part of today's session, we turned our focus to EBIT and EPS analysis, a vital tool for evaluating financing alternatives and determining the most effective capital structure. We explored how these two analyses aids in understanding the trade-off between debt and equity financing and how these decisions impact shareholders' returns. I hope this session has provided you with a holistic perspective on leveraging these analytical tools for strategic financial decision making. Thank you once again for your engagement, and I wish you the best in applying these concepts in your academic and professional endeavors. See you in the next session. Till then, happy learning.